In this discussion, we will discuss the discussion question of discuss the accounting related to bonds being sold to finance a capital project. If we see a discussion question or essay question like this, our goal is often to expand on the discussion or essay question, that being more likely that we're going to pick up the points for an essay question that are being looked for and to be able to add to a discussion, therefore picking up the most points within a discussion forum. Keeping that in mind, let's go through this one more time. Discuss the accounting related to bonds being sold to finance a capital project. If we see a question like this, we're tempted to go right into the journal entry to record the bonds, but we might want to take a step back and start to think, okay, what are the things that are going to be affected if we were to record some transactions such as this? And I would think of this all the time with at least two components of it. One, government-wide level. This is going to be the government as a whole, the government-wide activity on a normal accrual basis. And then the fund accounting side of things, what types of funds will be affected. As we go through that process, I would first think of the government-wide level because it will be on the accrual basis, and then think about the funds that will be affected. So we're going to have the government-wide type of transaction. Which funds are going to be affected? Well, if we're issuing bonds, that's a typical type of thing that we will do in order to finance a capital project. The capital project is typically something that's going to be some type of long-term project, and we can go into some detail about what type of projects would be capital projects. But if we have a building or a bridge, some type of long project we're going to make, we're going to have the capital project fund, and then we may need to finance the debt in order to support that capital project, often then setting up a debt service fund. So these three items are often related when we're thinking about long-term projects, long-term construction, bridges, buildings, roads, things like that. We have the government-wide activities, capital project fund, and then the debt service fund. And then you might want to go through and think through an example of actually recording the transaction. I would first think of recording it into the government-wide activities and then think of the fund accounting side. If we were to record the issuing of a bond, then we could think of the bond having cash going up. That's why we issue the bond. So we could say, well, we're going to have this is going to be ugly, but I'm going to mark it off here. Say we issued it for $110,000. That's how much cash we got. Then we've got a bond payable. So bond payable, we're going to say that, let's say that's 100. And then we have the premium. So then we have a premium typically of, let's say, $10. We often issue it at a premium in these cases, but it's possible to basically have a discount. If we had a discount, then we would debit the cash, credit the bonds payable, and debit, in essence, the discount. So oftentimes we have the situation where we're issuing it for something higher than the face amount of the bonds, resulting in a premium. If that were the case, this would be basically a normal type of transaction, government-wide level. What would happen on the fund side of things? Well, on the fund side of things, we would have the capital project fund. And the capital project fund is why we issued the bond. We're going to take some of this amount we got, put it into the capital project fund so it can be used to make the capital project, to build the capital project, the building, the bridge, whatever it is. So we're going to transfer that in the capital projects funds. We're going to have cash go up for the 100, though, the face amount of the bond typically. So the cash will typically go up for the face amount of the bond, and then the credit will be other financing sources, which seems unusual. Other financing sources. I'm not going to write it all out for 100. That acts like a revenue account in the capital project fund. And it's different than what we would expect. You would expect it going up into a liability account. Why would that be the case? Well, because the capital project fund is a governmental type fund. The governmental type funds, modified accrual basis. Modified accrual basis doesn't have long-term liabilities. We're not going to have the bond payable in the capital project fund. What we are recording is kind of the flow, what's happening. And so we're going to say that this is how we financed it in the capital project. It's going to be in like kind of what we would expect similar to an income statement account, one that's going to close out to what would be similar to an equity account in a for-profit type of organization. It's going to be in the other financing sources. Then we have the debt service fund. The debt service fund is usually there to service the debt. We want to show the payments of the debts that are typically being made. Oftentimes, if we have a premium, we're going to put that in the debt service fund. So we're going to debit cash, and for the 10, the premium goes here. So the premium is going into the debt service fund, and the amount of the face amount of the bond is going into the capital project fund. And then the other side of the debt service fund would be other financing sources as well. Once again, the debt service fund, like the capital project fund, governmental type fund, therefore on a modified accrual basis. Therefore, although it's called the debt service fund, we won't have long-term debt recorded as a liability in it. There is no long-term debt. What we're recording is the flow of activity as we service the debt. Why would we put the premium in there? Because that's basically related to the interest. So typically we're thinking about that's going to be the portion we're going to use in order to pay off the future interest payments, and therefore that's why we would put it into the debt service fund. Now, it's possible for us to have a situation where, of course, we paid, got the cash that's equivalent to the bond. We issued it at par, in which case we would just put the full amount into the capital project fund typically, and not have anything in the debt service fund at the point of issuance. Or it's possible we have a discount, at which time we would have the cash would be smaller than the payable. And if that were the case, the amount that would go into the capital project fund would typically be the cash rather than the face amount of the bond, because that's all we would have had. If we issued it at a discount, the cash would be lower than the face amount of the bond. That then is what we would put into the capital project fund. Again, upon the issuance of the bond, we wouldn't have anything at that point in the debt service fund.